If you're 25 and investing the same way as someone who is 65, my friend, you're doing it wrong. The truth is, investing is not one size fits all. What works for a young professional just starting out, it's completely different from what works for someone who is getting ready to retire. Think about Warren Buffett. He bought his first stock when he was just 11 years old. Now, he often says his only regret was that he didn't start earlier. And that's the power of time. Buffett didn't get rich because he chased the hottest stock. He became one of the world's wealthiest men because he started early, stayed consistent, and let compounding do its magic over decades. I'm Dr. Z, a university professor and a long-term investor. I started this channel to share what I know, what I have learned, and what I'm still learning, so you can make smarter financial decisions. In this video, I'm going to walk you through a simple step-by-step investing blueprint that matches every stage of your life. Whether you're just beginning your career, hitting your peak earning years, or approaching retirement, or already retired, you will know exactly what to focus on. But before we get into the specific strategies for each life stage, let's start with the timeless investing principles that apply to everyone, no matter where you are in life. Think of these as the foundation you can always come back to. First, start as soon as possible and be consistent. Timing the market almost always beats timing the market. Compounding is powerful. If you invest just $200 a month starting at age 25, you could retire as a millionaire. But if you wait until 40 to start, you will have less than half of that. Time really is your biggest asset. Second, diversify. Don't put all your eggs in one basket. During 2008 crash, people who only owned tech stocks saw their portfolio collapse. While those with diversified portfolios recovered much faster. Diversification doesn't eliminate risk, but it smooths out the ride. Third, keep costs low. Fees quietly eat away at your wealth. A 1% annual fee may not sound like much, but on a $100K portfolio over 30 years, that's nearly $100K gone. Index funds and ETFs are your friends here. Now, fourth, keep a long-term mindset. Markets will go up and down. In 2020, the market fell 30% in just 1 month. Those who panicked and sold locked in the losses. Those who stayed invested saw their portfolios bounce back within the year. Patience pays. Fifth, match risk to your time horizon. If you're young, you can take more risk because you have time to recover from downturns. But if you are nearing retirement, you need more stability. Finally, always maintain an emergency fund. 3 to 6 months of living expenses in cash can protect you from having to sell investments at the worst possible time. During the 2008 financial crisis, many people had to cash out investments at rock bottom prices just to pay the bills because they didn't have the safety net. These principles are timeless. No matter where you are in life, they give you stability, confidence, and protection. Now that we have covered the foundation, let's talk about how to apply these principles if you're in the early stage of your career, your 20s to early 30s. That's where the habits you build today can make the biggest difference tomorrow. Now, step 1, pay off any high-interest debt. Credit cards charging 20% of interest can destroy your finances faster than any investment can save them. Clear that debt before you go heavy into investing. Next, take full advantage of retirement accounts. If your employer offers a 401k match, grab it. That's basically free money. And it's one of the easiest ways to start building wealth. In your 20s and early 30s, you also have something extremely valuable. That's the time. Because you have decades ahead. You can afford to take more risk. That means leaning heavily towards equities, stocks, and index funds. Yes, markets will go up and down, but over the long run, stocks give you the best chance at growth. But remember, building wealth is not about chasing quick wins. It's about developing good habits. Automate your contributions, learn to budget, and commit to being consistent. Start small and let time and compounding do the heavy lifting. Now here's the example. If you invest just $100 a month starting at 22, by age 65, you could have close to $500,000. If you wait until 35 to start, you will have only about $180K. The difference isn't how much you invested, it's simply time. So in your early career, your mission is clear. Pay off high interest debts. Invest consistently and let compounding work for you. Now, as you move forward in life, your responsibilities grow, income rises, but so do expenses. Mortgages, kids, lifestyle updates. That's where we shift into the next phase, the mid-career strategies. Now we're talking about your mid-career years, your 30s through 50s. This is usually your prime earning period. Your income is higher and so are your responsibilities, like mortgages, kids, maybe college savings. And the key here is to maximize growth while protecting your future. First, as your income rises, increase your retirement contributions. Aim for 15 to 20% of your income. If you haven't hit that target yet, now is the time to push towards it. Second, think about the diversification. In your 20s, you could go almost all in on stocks. But now, it's smart to add some balance. This could be bonds, real estate, and even alternative assets, depending on your comfort level. Third, if you have children, consider planning for their education. Accounts like 529 plans can grow tax advantages and take a big burden off the future. Fourth, protect what you have built. This means having the right insurance, updating your estate plan, and making sure you are not over-leveraged with debt. Finally, watch out for lifestyle inflation. I have seen this so many times. Now, someone gets a raise and suddenly they are upgrading to 2 luxury cars in the driveway. It feels good in the moment, but it eats away at your future freedom. The people who keep driving a Toyota and invest in the difference often end up financially free 10 years earlier. So, mid-career is all about building wealth with discipline while balancing your family and responsibilities. Now, what happens as you get closer to retirement? That's when things shift. In your 50s and early 60s, the focus changes from growing wealth to protecting it. Now, let's talk about pre-retirement strategies. The decisions you make now can determine whether your retirement years are comfortable and secure. First, consider shifting to lower risk. Gradually reduce your exposure to stocks and increase your allocation to bonds or cash. This helps protect the wealth you have built over the decades from a sudden market swing. Next, take advantage of catch-up contributions. If you're over 50 and the IRS allows you to contribute more to your 401k or IRA, it's a simple but powerful way to boost your savings before retirement. It's also important to test your retirement plan. Estimate your future living expenses and run projections to see how your investment, social security, and other income sources will support you. This gives you a realistic picture of what to expect. Paying off debts is another crucial step. Entering retirement debt-free, especially free of a mortgage, can bring tremendous peace of mind. Many people find that even with a smaller net worth, being debt-free reduces stress and gives them more flexibility in retirement. Finally, plan for healthcare. Look into long-term care insurance and Understand Medicare options. Unexpected healthcare costs can be one of the biggest risks in retirement. So, planning ahead is essential. By taking these steps, you reduce risk and solidify the foundation you have built over decades. And as you prepare to take the next step, we will move into post-retirement strategies where the focus shifts to generating income, managing longevity, and enjoying the retirement you have worked so hard for. Withdrawal strategy. A common rule is a 4% withdrawal rate. Taking more could risk running out of your money too soon. Think of it as pacing yourself for the long journey ahead. Income streams. Social security, pensions, annuities, dividends, and bond income all combine to give you a stable base. Diversifying income sources reduces stress and keeps you financially secure. Keep growing some assets. Even in retirement, keeping a portion of your portfolio in stocks helps hedge against inflation. Your money continues to work for you without taking unnecessary risk. Tax-efficient withdrawals. The order of withdrawals matters. Typically, you start with taxable accounts, then tax-deferred accounts, and finally, Roth accounts. This strategy can reduce your lifetime taxes. Retirement is also a time to consider your legacy. Wills, trusts, and charitable giving ensure your wealth is passed on efficiently and according to your wishes. Retirement isn't a finish line. It's a new phase where careful planning matters. And with these strategies in place, you can focus on enjoying this chapter with confidence and peace of mind. Now that we have covered strategies for every life stage, let's wrap up with the key takeaways and how you can put this into action today. No matter your age, there's always a step you can take right now to strengthen your financial future. If you want a practical next step, I recommend checking out my previous video on the best payday routine. I will put a link right here. It's a simple, actionable approach that helps you build a solid financial habit every month so you can grow your wealth steadily over time. You will find it really helpful for putting these investing principles into action. So please don't miss that. If this video helped you feel a little more confident about your investing journey, please give it a like. Subscribe to the channel for more practical real-world money tips and share this with a friend who might benefit from a little guidance too. Let's make smart investing simple together. Thank you for watching, and I will see you in the next one. Have a good day.